Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy Live Trading Room. We're live streaming in YouTube. Let's take a look here on this segment at the discussion that is going on right now with regards to regulating digital assets. It appears that there is some regulation that's going to be coming into the market, and we'll take a look and see how it's affecting the markets in general here as well. Let's take a break here for a minute, and we're going to come back and take a look at the weekly report. We're going to review the weekly report that we published on Saturday and see pretty much what has happened so far. So stay with me. We'll be right back. We're taking a look at gold, trading around the average daily and the weekly. The numbers on the right of the screen are the weekly numbers, and the numbers on the right of the screen, on the left of the screen, are the daily numbers. Let's take a look at what's happened here in the market. As you can see, the market came into a level of support at 1781 roughly. 1780.60 was the low that was made yesterday, and we've been trading around the average now, above the average daily and above the average weekly. And the market is consolidating pretty much the gains that were made yesterday around the 1800. So right now, the logic basically of the VCPMI in terms of day trading, there is no signal right now. The market got up to a high of 1808.30, and we've been recommending our traders in our live trading room here that you take some profits. If you're trading in the future short term, these are good levels that as close to 1810, you want to take some profits short term. This doesn't change the long-term outlook that I have in the market, which is the market is prepping, it's building a bottom. And the low that we made yesterday of 1780.60 may very well potentially hold as the low for the next extension that we're looking to have on a bigger scale. The low of 1678 that was made on the 9th of August was a major confirmation that the market penetrating into these levels of blue, into these levels of support, is going to find buyers that are willing to pay up for this price up here and take all this supply out of the market. And in fact, we did. It reverted right back up above the levels of support, and we went up right into the resistance level of 1810.90. This resistance level basically was and is the yearly average of 1810. So we've been trading around this average now of 1810, just under 1810, 1800, 1780, 60 yesterday. And let's take a look and see moving forward from here potentially what the AI is recommending, is suggesting for us for the remainder of the week.
Hello everyone, this is Equity Management Academy with a weekly gold report for September 10, 2021. Summary: the trend momentum of 1801 is bearish. The VCPMI of 1802 is bearish price momentum. A close above 1802 stop negates this bearishness neutral. If short, take profit 1770 to 1752. Trading instructions. Weekly trend momentum, 1801, bearish. The gold futures contract closed at 1792. The market closing below the 9-day SMA 1801 is confirmation that the weekly trend momentum is bearish. A close above the 9 SMA would negate the weekly bearish short-term trend to neutral. Weekly price momentum, 1802, bearish. With the market closing below the VC weekly price momentum indicator at 1802, is confirmation that the price momentum is bearish. A close above the VC weekly, it would trigger weekly stops and negate the bearish trend to neutral. Weekly price indicator. Exit, longs. Sell 1, 1820. Sell 2, 1850.
Okay, so this 1802 level basically is the average that we're looking at for this week. We've been looking at for this week, and the market closing at 1792 on Friday was closing under that average. So we came into the week basically with a bearish sentiment, but a rally into that target would complete the pattern, and a close below would again revert the bearish sentiment, the bearish price momentum, and it would activate the 1770 to 1752 level. The upper end of the mean or the resistance levels above the mean are 1820, 1852. These are the targets that we have on the weekly so far coming into this week. And we've been chopping pretty much around that area. Let me I want to take a look at the report that we published in Marketplace Seeking Alpha for the benefit of our subscribers here on September the 10th, which is basically the intelligence that is provided by the algorithm. And we just reviewed Nikki the robot basically analyzing or excuse me, identifying this data, this information for us. This report was written on September 10 in Marketplace, and pretty much the summary, the trend momentum is 1801, which with the market closing at 1792, it came in bearish. Now, the trend momentum basically is the bigger picture of the market. It's the bigger trend of the market. It's not a trigger point, but it gives you the temperature, so to speak, or the climate or the sentiment, basically, of the trend of the market, up, down, sideways. Now, the VCPMI, which is the variable changing price momentum indicator, is the mean or the average price for the week, or the equilibrium, as technical analysts would call it. So we have identified the trend momentum and also the price momentum. Now, the price momentum is different than the trend momentum in that the price momentum is the volatility or the velocity of price within that bigger trend. So if you're coming in here this week with a bearish trend momentum, the market closing below 1801, and a bearish price momentum, then we have a pretty good idea of the climate coming into this week. And as we come into this week, obviously, we'll take a look in a minute here, but at the same time that the VCPMI gives you the price momentum of the market, it also gives you the alternate count that basically, even though it's bearish coming in and it closed at 1792, if we close above 1802, stop. This means that this is your protective level on these shorts. Above or below 1802, it changes the price momentum, which is the VCPMI represents and stands for the variable change price, changing price momentum indicator. It will change, the price momentum will change, or the volatility of price will change within that bigger trend. So we're using a combination of the trend and the price within the trend that identifies the momentum of the market. It also gives you a protective level of 1802. If you come in short, that's where you want to manage your stop. If you're a short-term trader, a day trader, an investor may have a different approach, a different psychology, using different data. The information that I'm writing on this report is primarily for short-term trading, intermediate trading, which is weekly and monthly. We offer in the chat room, in Marketplace, basically, the opportunity to chat, to share. We share our videos daily, our live videos, so that you can have access to all this information, which is essential if you want to be completely independent of trading without emotions. This is a probability model, a mathematical model. And the price basically will shift the momentum. It will activate the momentum, the price momentum. And so we have a two-frame dimension, so to speak, of the market and the price momentum, up or down. It will activate the trigger points. And so coming into this week, it's telling you that if we come down to that 1770 or 1752, these are the targets for you to cover your short position if you short the market. If the market trades above 1802, it negates this short-term signal. We're trading at 1797. And pretty much since we published this report, you can see the market reaching a high of 1810.60. The 1810, the 1810, 1812 area, 1814 is a very critical level of resistance. And that represents basically, as you can see here, the daily, the weekly, and the monthly, basically. I want to take a look here for a minute at the monthly. The monthly average is 1777. And the market came down to a low of 1677.90 on August 9th. But what you want to see is the resilience of the market. And what the VCPMI does, once again, is a GPS that tells you basically when the market traded above 1718 after this attack, you might say, or a substantial amount of paper shorts. Paper, not necessarily the actual physical, but simply paper to what I call manipulate the price into the lower levels where it finally would find real strong buyers. And those buyers will take all the supply. In the meantime, they wiped the market out. They took out all the stops, and then the market reverted. Now, here's where the trigger came in, that when the market came back up above 1718, that's pretty much, or that level, it reverted right back up again, activating a monthly buy trigger. And this identified where the level of support was, even on the annual target closing below 1810. So we're looking at a market that seems to be trading around the averages, and if we do get a close above 1810, that's going to activate now and bring in the annual target. So we're getting a conglomerate of different cycles and signals that are identifying pretty much that the market is trading at a very strong level of support. The average or the mean daily, weekly, monthly, annually is basically the level, the average price, obviously, that all of those trends are aligning themselves to. And that is pretty much the harmonic alignment that we're looking for, that gives us a pretty strong conviction in order for us to take advantage of the trends and the beginning of what could be some really phenomenal moves. let me come back here to my Thinkorswim platform here. I'm having some issues here with my trade station this morning. And it's always good to have a backup, by the way, in case you get stuck or something happens, with a platform. You want to have a backup always. So let's take a look at a couple of markets here, as the gold market seems to be in a neutral area. The strongest market actually that we have here today in terms of the metals is the silver that seems to be leading the way. And in the silver market, you can see we're trading above the average daily of 23.77, and the weekly average is at 24.14. And so we're trading in between those prices, and that's a neutral area. Trading around the average, around the mean, around the equilibrium, it's a neutral area pretty much. And we are going to maintain pretty much, our bias in that the market is in a bullish mode from these levels here of 23.36. We have almost like a double bottom in here. 23.81 was made on September 14th. And so far today, they try to bring it down to a low of 23.67. So higher lows seem to be coming into the market here. And let the market dictate pretty much the way the price wants to trade around this. But essentially, when we identify the average price, then we can extrapolate the extremes above or below that average price. That gives us where the highest levels of speculation may congregate. And as a trader, I want to trade the highest probability trades that I can find, in terms of how I manage my risk, as opposed to just trading at random chart formations, general patterns that are after the fact. One of the strongest points of the algorithm basically is that it gives you the ability for you to prospectively see where mathematically it can identify the extremes in price for this, based upon obviously the current data that's been produced so far. And we extrapolate that data, we identify an average price, and that average price gives us the extreme levels above or below. And we use pivot points, but the algorithm pretty much activates those pivot points as a probability factor mathematically, that it identifies where, for example, the highest probability would be to find a reversion. And when we're trading around the average price, it's a 50-50 standard deviation. It can go either way. And as a trader, and what I'm recommending is to trade the highest probability trades, and that is when the market comes down into the blue levels, basically. Of support, look to sell at the extreme above. So the extreme below the mean or the average price that you see is essentially the buy one and buy two level. These are levels of support. And these levels are identified with a 90 to 95% probability that if the market comes down here to these levels and activates a trigger point, which is closing above this level upon testing it, it activates a trigger point. That is the algorithm saying buy, and when you buy, automatically it gives you the levels below to use as your protective level. And depending upon how conservative you are, you can use the close below conservatively. You can use a dollar stop to your comfort level, or you can use the level below, which is the B2 level, if you want to enter into multiple positions. Automatically, when the signal is activated, it gives you your targets, which is the mean. If you're buying from B1, it's the level above, and that's the average price. If the market trades above the average price, you're looking at the level above as the target. Now, the 1810.60 was the high that has been made so far, and it's been the market has been trying to test this, and this is the yearly average price. And so if the market trades and closes above 1810, it's going to activate all the trends, and we're looking at the sell targets, all the way up to 1852 on a weekly basis for the rest of this week so far. But the targets now looking at in the levels of about 1818 to 1852. This is where the algorithm is saying that this area potentially can be the highest area where you could see supply come into the market. So let's see what the market does. And we either are going to come down and test these levels again of 1788 to 1770, which would trigger another buy entry point weekly and also daily. And also, I want to point to you that 1770 and the level daily are pretty close harmonically. And this would be the strongest area to enter into the market on the long side. Thank you again for the opportunity to share this information with you. In the meantime, my friends, I'll see you soon. I'll see you next time. Have a great trading day. We'll talk to you soon.